Hi, welcome to Bank Reconciliations and Bank Errors, when we'll look at what happens if a bank, if we find there's been an error as part of the reconciliation process in the bank statement. Okay, they're horrible questions, these, to be honest. I think in some ways it's the hardest thing to get your head around in AS, A2 and IGCSE accounting. And unfortunately for you guys that this video is aimed at, it's only really done in one exam board, which is a Cambridge IGCSE board. So it's tricky. Now, the three key things to bear in mind, therefore, is first of all, it doesn't come up that often in an exam. And secondly, and almost as importantly, it's only worth 1 mark. So that's 1 mark out of a possible 120 marks. So it's not catastrophic if you get it wrong in an exam. It's not going to be something that means, or for most people means, that they either pass or fail. Okay, and also in the exam, if you're not 100% clear on it and you know you've got it wrong, don't waste a lot of time for 1 mark trying to get it perfect. Okay, you're far better off getting on with other questions and getting the marks there, because if you do end up sitting there and being a bit stumped by it, you can waste a lot of time. So really important that. Right, I've got an example here where we've got most terms you're already aware of, balance as per the updated cash book. We've got the balances per the bank statements, and we've got some unpresented checks, and we've got some amounts not yet credited in the bank statement. And then we've got the error that we're going to deal with. My advice, just because the logic of this hasn't follows better from going from balance as per the bank statement, that you do the question starting with the balance per the bank statement. And it's a credit balance, so don't forget the bank statement is done from the bank's point of view, and they see that they owe money to this business. So therefore it's a positive balance, there's money in the bank, and therefore I put it in here as a positive figure. And again, just so that we're contrasting and remembering this difference between the cash book and the bank statement, the cash book shows a debit balance. That means the business thinks that they should have $3,100 in the bank. So again, that's a positive amount, because from the business point of view, it's an asset. And then we'll quickly deal with the two that you should already be able to handle. We've got checks not yet presented at the bank. So that's a check that we've sent to a supplier that has yet to either go from the supplier to their bank, or the supplier's bank haven't contacted our bank to get that $500 transferred over. And we take that off because although the bank think that we've got $3,200 in the bank, we know from our cash book that $500 of that is going to get paid to a supplier. And then we've got the $1,000 not yet credited at the bank. And that gets added. And it gets added because the bank have received the money, or possibly some checks that we've paid in, and yet they haven't fully gone through the bank's process for that to be recognised in our bank account. Putting cash in, to be honest, gets picked up quite quickly, but sometimes it takes 2 or 3 days for a check to clear. So it's more likely to have been a check, but it could have been cash paid in on the last day of the month. And now we get to the error. And in this case, the bank has credited the bank statement in error for rent received on a private rental property. So that should have gone into the person's personal account, or the business's personal account for the owner, rather than into the business account. And if they've credited it, then that means that they've included that as part of $3,200 that the bank think they owe to the business. And they don't owe that to the business, they should have put it in a different account. So that is going to reduce the amount of money that the bank think that they owe to the business. So in total, the two amounts that were less, and we've got the unpresented checks and the credit error in the bank statement, we need to take $1,100 away from the amount the bank think they've got in there, to get to what the real amount should be. And then we've got a final thing that we need to do. Now, I've not put anything in this box deliberately because in this case, we haven't debited anything in the bank statement in error. It's been credited in the bank statement in error. So the total amount that we need to add as part of the reconciliation process is 1,000. And therefore, the balance as per the cash book, if we do the maths, is the same as the actual balance per the cash book. And therefore, we would say that we've managed to reconcile the cash book and the bank statement. If we did, instead of having an amount credited in error, had an amount debited in error in the bank statement, what that would mean is the bank have they have thought they've paid out some money for this person, and they shouldn't have done, and therefore they are going to add it into that 3,200 when it gets corrected. Okay, so I know some of you like templates. There is a little bit of a template there that you can learn to do this. But again, I must stress it's 1 mark in an exam. 1 mark out of 120. If you're struggling with this, have a go at doing it in the exam by all means, but make sure you limit yourself to 1 minute. And if you don't get it right, just balance off the reconciliation, make it clear you recognise that there's an error somewhere in there, and just leave it at that. Right, any questions, email me. For those of you I teach, I've put some questions for you to have a go at, and I'll also be sharing with you some past paper questions. Thank you very much, and good luck.